Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Today, guys, we're going to look at inventory valuation. At the end of this lesson, you should be able to calculate the value of closing inventory using the first in, first out method for a business that uses the periodic system. Let's look at inventory valuation system. We have the perpetual system. This system tracks and updates inventory records after every transaction of goods received or sold with the use of technology. The other system is the periodic system. This is a method of inventory valuation for financial reporting purposes in which a physical inventory count is performed at specific intervals. So the inventory is manually counted at a scheduled time. All right, let's talk some more about the periodic system. It does not track how many items are sold. It can be time consuming to do a physical count of all stock. Now, please note that the periodic system is mainly used by small businesses. Okay? Now, it can be very costly to maintain because it uses a lot of manpower, hence done at a scheduled time. We do not know how many items are left until a physical count is done. And the final thing, it takes inventory at the beginning of a period, which would have been your balance coming from the last period, adds the new inventory purchases, actually your purchases for the period, and deducts ending inventory to derive the cost of goods sold. Let us take a look at inventory valuation methods. The most common methods of valuing inventory are: one, specific identification, and this is where actual units are physically identified and their total cost is reported as the cost of goods sold. It will take a lot of work upfront for a business that practices this type of inventory valuation, and it would not be practical for a business that sells small items such as shoes, t-shirts, etc. It is mostly used by firms that sell larger items such as vehicles, heavy duty equipment, furniture, etc. Okay? Another method is average cost. And under the average cost inventory valuation method, an average cost is assigned to each unit sold or in stock. And in order to derive at the ending inventory, the number of units on hand is multiplied by that average cost per unit to get the closing stock. Another method is the first in, first out method. And for this one, the assumption is that the first units acquired are the first to be sold, meaning the first set of items to come into the business are the first to be sold. So basically, they leave in that same order in which they came in. Okay? And an example of products that can be valued using the first in, first out method would be like perishable items. All right. And the other method is the last in, first out. And the assumption is that the last units acquired are the first to be sold. So what came into the business last tend to go first. Example of a product that can be valued on the last in, first out method is like trendy items. So, for example, if it is that you're going to, say, a party then, and you want to purchase garments to be worn, then you won't be purchasing something that is vintage. You'd more be purchasing something that is in style. Okay? Shoes, persons tend to go for those things that are trending. Phones as well. A lot of persons wouldn't want to be purchasing a phone that is out of style for a couple of years. No, they'd more go for the more up-to-date device. All right. Now, let us look at a question where we value inventory using the first in, first out method. White Inc. began buying and selling accounting workbooks on January 1st, 2010. Purchases of the workbooks during the financial year were as follows. We have for January, February, March, April, May, December. And the total number of units purchased for the period was 140 units. And the total cost for that 140 units is 83,500. 50 of the workbooks remain on hand. So they're saying that 50 workbooks were not sold. 50 workbooks are now in the business. On December 31st, 2010, the company's average selling price during the year was $800 per book. So this is saying that each book sold was sold at $800 per item. All right. White Inc. uses a periodic inventory system. Calculate ending inventory and cost of goods sold under the first in, first out method. Now we're going to move over to the worksheet to get that done. Okay, so let's talk about this question before we get into working. All right, note 50 workbooks are on hand, meaning 50 books are within the business, 50 books were not sold. But we were told that a total number of 140 books were purchased. And if it is that we have 50 books remaining, it means that we can determine our number of books that were sold. So that would be the total purchase, which is 140 minus the 50 books, and this would give us 90 items sold. Okay, now we are talking about the first in, first out method. And if it is that the business sold 90 units and we are using the first in, first out method, which units would be sold first? All right, first in, first out. So it means that they would have sold the 15. They would have also sold the 25, and we're using this order because this is how they came into the business. So we would sell the January set first. We still need more, go down into the February set, and that gives us a total so far of 40 units. They sold 90, so it means that there are 50 more items that were sold. This 50 would have been taken from the set that were purchased in March. So when we subtract that 50 from the 60, we have a total number of 10 books remaining from the March purchase. All right. Now, from the March purchase, as indicated earlier, we have 10 units remaining. So guess what? What do we have on hand? We have the 10 from March. We have the 5 from April. That is a total of 15 so far. We have the 15 from May. That added to the 15 would give us 30. And we have the 20 from December. And that would give us a total of the 50 books that we have on hand. All right. So basically, when you're using the first in, first out method, to value your ending inventory, you start counting from the items that came in last. So you'll be counting from the bottom going to the top. So we're going to start with the 20 units at $670 each. Then we'll go to the 15, to the 5, and then to the 10, and that will give us our total of 50 units that we have on hand. So remember, when you're valuing your closing inventory using the first in, first out method for a business that uses a periodic inventory valuation system, you start from the bottom and you add to the top until you get the number of units that you have on hand. So let us now move into doing the calculation of our ending inventory. So we'll start with our December set. So that will be the 20 times the 670 per unit, and this will give us a value of $13,400. Then we move into the May set, and that is 15 times the 650 per unit, and this gives us a value of $9,750. We only have 35 units accounted for so far, which is the 20 and the 15 added together. We still need 15 more units. The 15 units, we'll take the 5 from April because that is still not sold. And the 5, each of them cost $620. So that is 5 times $620. And that gives us a value of $3,100. And so far we have 40, so we still need 10 more. And based on the explanation earlier, we have 10 items remaining from March. So that is 10, and the cost per unit is $600. So that would give us a value of $6,000. And our final thing now, once we have the 50, so that is the 20 from December, the 15 from May, the 5 from April, and the 10 from March, and we can now value the closing inventory. So we're going to add all the values, and that gives us a total of $32,250. That is $32,250 that we have as our ending inventory using the first in, first out method. Okay, we are now going to calculate our cost of goods sold. And we know that we have sold 90 units. Earlier, we have deducted the amount we have on hand from the total units purchased for the period. So the total units that came in for the period. All right. Now, first in, first out, we are valuing our cost of goods sold. We sold 90 units. What did we sell? Remember, earlier we determined that we sold the 15 because it's first in, first out. We're going from the top to the bottom to determine what we have sold. So the 15 units that were purchased first, the 25 units that were purchased in February, which would have been after the 15 units, and that gives us so far a total of 40 units. We sold 50 units from March, so it therefore means that we now have the total number of units that we have sold. So out of the March purchase, we have sold 50 units. It means that 10 are remaining. So with that information, let us now do our calculation. And we are calculating the cost of goods sold. So that would be the 15 multiplied by the 500, and that gives us a value of 7,500. We're starting from the top because we're using the first in, first out, so you sell from what comes into the business first. Then we sold the 25 by the cost price of 50, and that is 13,750. And please note, people, when you're valuing your ending inventory and your cost of goods sold, you use the cost price. This is done at cost price. We sold from the March set as well, because so far when you check January, that is 15, February added to that would give us just 40. And we have determined earlier that we sold 90 units. So we sold 50 out of the set that was purchased in March. So that is 50 times $600 per unit, and that would give us $30,000. We're now going to add these together to give us our total cost of goods sold, and that is $51,250. All right, so that is basically it for calculating your ending inventory. Remember, under the first in, first out method, you start valuing your ending inventory from the bottom up. So you start from the last set, and if you need more, then you move into the set that came in before that, going up until you get the total number of units that you have on hand. Because if you're using the first in, first out, it means that from the top, those would be the items that were sold, coming in that direction. But what you have left, you'll do the reverse, determine what you have on hand. So you start from the bottom up to the top. But to add to that, you know that you could be asked to calculate your gross profit. And in order to calculate your gross profit, remember, it is sales minus your cost of goods sold that would give you your gross profit. All right. So from this question, that could be an addition to the question. Now, in order for you to get your sales, remember in the question you were told that each book was sold for an average cost of $800. So if it is that you sold 90 units, your sales would be the 90 times the $800 per unit. And then from that, you will subtract your cost of goods sold that we have determined earlier, which is $51,250. And that would give us a value of $20,750 as our gross profit. So the 90 is the 90 items that were sold. We multiply that by the average cost, average selling price per item, and that would give us $72,000. And from that, we subtract our cost of goods sold, and that gives us our gross profit of $20,750. So that takes us to the end of our lesson, where we value ending inventory, cost of goods sold, and determine the gross profit for a business that uses the periodic system. And remember, we were using the first in, first out method. In our next lesson, we will look at valuing ending inventory, cost of goods sold, and even calculating the gross profit under the periodic system, where they use the last in, first out method.
Like, share, and don't forget to subscribe.